Running a childcare service is one of the most rewarding things you can do, and one of the most heavily regulated. Behind every centre sits a financial engine that's genuinely unlike any other small business. Government subsidies that shape your cash flow, a large casual and part-time workforce under specialist awards, inclusion funding and significant investment in premises and fit-out. Get the numbers right, and your centre runs smoothly. Get them wrong, and you can face surprise subsidy clawbacks, payroll underpayments, or compliance headaches. I'm from Quantum House Australia, chartered accountants, tax advisors and registered auditors, and in the next few minutes I'll walk you through the key financial issues for childcare operators and how the right accountant doesn't cost you money but protects it. Here's what we'll cover. First, why childcare accounting is different. Then the GST position and a 100% input tax credit point that's widely misunderstood. We'll look at how the Child Care Subsidy shapes your cash flow and the big change arriving in January 2026, the 3-day guarantee. We'll cover payroll, the awards, and the worker retention payment. We'll clear up how inclusion is actually funded. It's not the NDIS. We'll touch on capital and Division 43 depreciation. And then I'll show you exactly how Quantum House Australia helps childcare operators stay compliant and in control. Let's begin. So why is this so different? Because almost every dollar in a childcare business is shaped by regulation. Your fees are GST-free. A large slice of your revenue arrives as a government subsidy on its own schedule. Your wages run under specialist awards, with casual loadings and a government-funded pay rise to administer, and you've sunk serious capital into your premises and fit out. Each of those creates an accounting wrinkle that a generalist accountant simply won't know to look for. The stakes are real too. An unreconciled subsidy ledger can turn into a sudden clawback and a payroll misclassification into an underpayment claim. That's why a specialist who understands the sector isn't an expense to minimise, it's protection worth having. Families are also more discerning than ever about the centres they choose, and the operators who thrive are those who pair genuine care with a business that is financially well run beneath the surface. Let's start with GST because there's a point here that's widely misunderstood. Childcare services provided by a registered provider are GST-free under the GST Act, so you don't charge GST on fees to families. Now here's the key. Because childcare is GST-free rather than input taxed, you're entitled to claim back 100% of the GST input tax credits on the expenses you incur running the centre. GST-free supplies do not reduce your creditable purpose. They don't limit your input tax credits at all. Apportionment only comes into play if a centre also makes input taxed supplies, which is uncommon. Where you do make straightforwardly taxable supplies, selling uniforms, say, or hiring out the facility after hours, you charge and remit GST on those and code them correctly in your BAS. Get this right, and you claim everything you're entitled to. Next, the Child Care Subsidy, the CCS, and what it does to your cash flow. The subsidy is paid by the Australian government directly to you, the provider, on behalf of eligible families, usually within a week or two of the session. You charge the full session fee and collect only the gap fee, the difference, from the family. The rest comes from the government. So your revenue is recognised at the full fee, but a large part of it is collected from a single government payer on a different schedule to your family payments. That creates an unusual receivables profile, and it's the source of one of the biggest risks in the sector. Unreconciled CCS receivables, which can turn into large, unexpected clawback demands that arrive with little warning. The discipline that prevents this is simple but essential. Reconcile your CCS receivables against Services Australia payments every week, not once a year. In practice, that means building a simple weekly rhythm. Match what Services Australia actually paid against what each family's entitlement should have been. Investigate any difference straight away, and never let the gap quietly accumulate over a quarter. Now, an important change because the rules are shifting. Up until January 2026, how many subsidised hours a family received depended on the activity test, broadly their level of work, study or other recognised activity. From the 5th of January 2026, that activity test is being replaced by what's called the 3-day guarantee. Under it, every CCS eligible family is guaranteed at least 72 hours, 3 days, of subsidised care per fortnight, regardless of their activity level. For your centre, that matters in a very practical way. Families who were previously entitled to fewer hours will step up to 3 days, which can lift demand and shift the balance between subsidy and gap fee across your enrolments. It's a change worth planning for, both in your capacity and in how you forecast revenue. Payroll in childcare is among the most complex in any industry. Your educators, assistants, cooks and admin staff are covered by either the Children's Services Award or the Educational Services Teachers Award, depending on their role. Those awards set minimum hourly rates by classification, plus a range of allowances: meal, first aid, broken shift, laundry, superannuation on all ordinary time earnings, leave loading and casual loading for your casual staff. One common trap is misclassifying permanent part-time staff as casual, which creates real underpayment risk under the Fair Work Act. And there's a newer layer to manage: the Early Childhood Education and Care Worker Retention Payment. This is a government grant funding a wage increase of 15% above the applicable award rate, phased in from December 2024 and reaching the full 15% from December 2025, which approved providers must pass on to eligible workers and account for separately, along with the associated on-cost funding. Administering that correctly is a job in itself. 2 more layers worth understanding. The first is inclusion funding, and there's a common misconception here. When you care for children with additional needs or disability, the support for your centre comes through the Australian Government's Inclusion Support Program, not, as is sometimes assumed, NDIS funding paid to the centre. The Inclusion Support Program's Inclusion Development Fund can subsidise the cost of an additional educator to raise your educator-to-child ratio and help include children alongside their peers. The NDIS, by contrast, funds a child's individual supports and therapies directly with the family. Mainstream childcare itself sits outside the NDIS, accounting for inclusion support subsidies. The recognition timing and reconciling against approved support hours adds its own layer. The second is capital. Your premises, fit-out and equipment are major investments to depreciate over their effective lives, and a purpose-built centre can often claim building construction costs at 2.5% a year under Division 43, which is exactly where a quantity surveyor's depreciation schedule, so often overlooked, pays for itself. For many centres, that quantity surveyor's schedule unlocks tens of thousands of dollars in deductions that would otherwise sit unclaimed year after year. Let me be candid about what's at stake. Going it alone or relying on a generalist, the risks build quietly. Unreconciled CCS receivables that become a surprise clawback. Payroll misclassification that becomes an underpayment claim. A worker retention payment obligation that isn't passed on or accounted for correctly. Each of these can hit your cash flow hard, at exactly the wrong moment. Now picture the other side. With a specialist accountant, your CCS is reconciled every week, your payroll is award compliant, your GST position is right, and you have a clear, honest picture of how the centre is actually performing. That's the real point. The right accountant doesn't cost you money. It protects your cash flow, your compliance, and your time. Do for childcare operators. We handle your tax compliance, GST and BAS, with the correct GST-free, full input tax credit treatment applied. We reconcile your CCS receivables weekly against Services Australia, so clawbacks don't blindside you. We support your payroll and award compliance, including the worker retention payment and reviewing casual classifications. And we manage your inclusion support reconciliation, your Division 43 depreciation planning, and regular reviews of how the business is performing. It's the full picture, compliance handled, and genuine insight on top. And because we work across many centres, we can also tell you how your staffing ratios, occupancy and fee structure compare with similar services, turning your compliance data into genuine business intelligence. Why Quantum House Australia? 3 reasons. We bring genuine childcare expertise. We work with centres and family daycare providers across Sydney, and we know the CCS, the awards and Division 43 inside out. We bring reconciliation discipline, weekly CCS reconciliation, and a documented input tax credit methodology, not guesswork. And we're a year-round partner, not a once-a-year visitor. Proactive support and performance insight whenever you need it. And when a matter calls for legal input, a funding dispute, a structuring question. Our colleagues at Australian Tax Experts, who are tax advisors and lawyers, can advise alongside us. One relationship, the accounting and the law together. These are the key takeaways. 1. Childcare is GST-free and you claim 100% of your input tax credits. 2. Reconcile your CCS receivables weekly to avoid clawbacks. 3. The 3-day guarantee applies from the 5th of January 2026. 4. Pass on and account for the worker retention payment correctly. 5. Inclusion is funded by the Inclusion Support Program, not NDIS funding to your centre. And 6. A specialist accountant protects your cash flow and your compliance. Get these right, and the numbers behind your centre stop being a worry and start working for you. Getting started is simple. It begins with a conversation. We learn about your centre, your enrolments, and where things stand today. From there, we map out a clear plan. Your GST, your CCS reconciliation, your payroll, your inclusion funding, and your depreciation, all scheduled so there are no surprises. And then we provide ongoing support through the year, keeping you compliant and informed while you focus on the children and families in your care. Most operators are genuinely surprised how much smoother things run with an accountant who already speaks childcare. There's no learning curve, no explaining the basics. So let me leave you with an invitation. Whether you need your CCS reconciled, your GST position confirmed, your payroll reviewed against the awards, or simply a specialist accountant who genuinely understands childcare, Quantum House Australia is ready to help. We'll take the compliance off your plate, make sure it's done properly and on time, and give you a clear view of how your centre is performing. Visit quantumhouse.com.au or call our Sydney office on 1300 809 697 and ask to speak with a senior advisor. Quantum House Australia, accountants, tax advisors, and registered auditors, setting a new standard. Thank you for watching, and we'd love to hear from you.